In the last 25 years, we've worked hard, we've saved our money, and we had two goals. We had our first, which was to make an annual return of 20%.
Now, 20% wasn't at first. I didn't learn that until I got, more advanced in my investing. But yes, ultimately we turned into that 20.
We want to make it 20%. Second goal is to reduce the investment, the risk that from the drawdowns that are coming from the market, those large market drawdowns. And that first challenge, that 10%, that is pretty much the stock market average over the last 100 years, it's hard to beat. I mean, if you buy and just held, you would make about 10%, but you have to go through a lot of...
I thought it was 8%. Has it always been 10?
Well, there's the small caps.
Okay, so everything combined has been 10.
Okay. 10. Now, even if we could manage to make 20% per year, would it even be worth the effort?
Now, and when you asked that question, I was like, what? Of course it would be. But I think it's important for our audience to know this because there's lots of other things out there that are flashing much bigger numbers.
Yeah. And that's kind of, we're going to answer that right here. So because a lot of people just don't see that, like they think 20%, maybe it's double the returns. Right. Like, so what is the difference between 10% and 20% returns? Now, this is long term. So we have 20 years. If you take $100,000 and let's say, okay, so 100,000 and you have 10% over 20 years, you make 672,000. That's compounded annually. If you do 20% annual returns, it's 3.8 million.
I mean, it almost looks like there's something wrong.
Yeah.
Because how can you go from double the annual, rate to having the balances be so grossly different? I mean, it's night and day.
Yeah. And so it doesn't even matter. Like, so whatever it is, like every percent counts. The difference between a 10 and 11% and then 12. I mean,
I remember
it's huge.
It's huge. I remember I used to refi, every like 7 months because I could save like, 10 bips on my interest, not 10 bips, but 0.5% on my interest rate.
Yeah.
But it adds up. Every little bit adds up. It's huge.
So this is also what it looks like compounded monthly, because there's a lot of people don't know that, but most people compound, or when you look at a calculator, it compounds it annually. But if you have something like with trading, what's nice about trading or any kind of strategy that trade, you can compound as soon as you get the return. Like once you close your trade, you can reinvest. But this is just taking a compounded monthly look at it.
So it's conservative.
Yeah, 7.32. 732,000 would be your 10% return ending balance, and then 5.2 million on 20%. So huge returns. So is it worth it? Absolutely. And is it worth putting a lot of effort into? It was for us. Now, be sure to subscribe and like the video if you like what we're doing here and find value. We're going to always bring content and keep it coming to you. Over the last 24 years, this kind of leads to our second challenge. We've been totally exhausted. I mean, I'm really speaking for myself too. Like my investment accounts, my IRAs, my 401ks, they've ridden up the markets and they've come back down 50% of the 50%. And what I mean by 50%, I mean those are drawdowns. Here's an example of the NASDAQ 100 on the past 24 years. I've been investing since, really I came in about somewhere in the year 2000. Mm-hmm. But the point is, this is the .com bust.
That was your first major investment. Yeah. It was right before September 11th.
85% drawdown. And a drawdown is from a peak to the next valley. So then you find the next greatest peak and then the next valley, that's another drawdown, 54%. That's, of course, the Great Recession. And this is 2018. Had at the end of the year was a big drawdown at 23%. And then that was pretty scary, but then we recovered. Here's COVID, 30%. And then since 2022, we've had a drawdown from this peak to here, 37%. So look at all that. That's 5 big drawdowns. We want to get rid of that. Here's the Russell 2000. That's pretty nasty looking. So again, if you buy and you hold, you have to hold through these drawdowns. The S&P 500.
Yeah. If we say buy and hold, you could also say, buy and get old. I mean, it wears you out. Mm-hmm. It completely wears you out.
Totally. It's emotional going through the roller coaster down, up, down, up. So we want to get rid of that. That's goal number 2. Here's the Dow Jones. It also got punished. Now, here's the stock market over the last 100 years, just you can see the fluctuations of the drawdowns, but about every 10 years, you should be expecting a drawdown. In fact, we should all be prepared for a drawdown of 50%. Like just be prepared. That'd be a really good thing to do. So we went to work I mean, we really worked hard looking for a way to make 20% annual returns and reduce the drawdown risk. That's what this channel is about.
We didn't actually think that we could find it.
Right. Well,
I mean,
you're right.
Yeah, we talk about it, but we did not think that you could actually find it.
So what we really had to do is, because we went through a bunch of different strategies, we made strategies, different methods, and we really found that the best way to do this would be to code it. But it would have to be done through a very dependable trading system. And TradingView, for those of you who aren't familiar, TradingView is a charting software. It's awesome. It uses PineScript as the code, and you can do lots of different things. There's indicators and strategies that you can build. So we went to work. We built a PineScript strategy. We back-tested it on demo and our live accounts. And this is what we've learned. That swing trading delivers us the most consistent returns with the lowest drawdowns compared to any kind of buy and hold or day trading strategy, or what you could call it a scalping strategy. We do not do scalping. This is not buy and hold, of course.
Now, how can we define swing trading in like 2 sentences or less?
It's right here on this screen. It's holding a position really between 1 and 3 days. That's my opinion. Some people may be saying it's up to 7, maybe 2 weeks. But you have, it's not this day trading or scalping is going in maybe for a couple seconds or a couple minutes or a couple hours.
Yeah, so totally different than any type of quick trade action.
That's right. So these are on 15-minute charts, and 30-minute charts is pretty much where we see a lot of our strategies being built, and they're built on on the swing trading. Okay, so we took the strategy and we applied it using a portfolio mix between the NASDAQ 100 and the S&P 500.
We wanted to take the human element out of this, so we didn't want to have companies with like a human head.
That's right. Take Tesla. I mean, if Elon Musk, something happens to him, or if he makes a decision or he tweets something or something like that.
He's already ruffled some feathers, and you can see what it's done, which is kind of beside the point, but anyway.
Yeah, I mean, if something happens to NVIDIA, a plant blows up or something that just happens out there in the market, we don't want to have really holding any independent company, but these strategies do work on companies.
And they're constantly updating too. You're getting these notices about someone jumping into the 100 and someone pulling out of it and someone being replaced. Walgreens was just pulled out. I think it was the S&P or was it the Dow? Anyway, these are constantly updating too.
So we really love the idea of, for the long term, staying in the NASDAQ 100 or the S&P 500 with these strategies. And this is what the result looks like with the NASDAQ 100 here. Over the last 24 years, now this is TradingView. Anyone who's familiar with TradingView and their strategy, they have a view where you can look and do a back test. And again, just a disclaimer about back tests, this is not a guarantee that all of these positions were filled, because this is a back test based off of the data, the trading data that it has, which we do think, in my opinion, I trust this. I mean, it's definitely better than anything else, but this is a quick disclaimer on that. And it's not a future guarantee of returns. This is what it looks like. And we're very, very happy because we've stress tested this many different ways. And we're really happy with the NASDAQ 100. What you can see is how smooth the equity line curve is and really reduced drawdowns. Also with the S&P 500, same thing. Lower, better returns, lower drawdowns, and we think that is just an overall win. Okay, so automation. I mean, we have day jobs, we have families, we can't be there at our charts all day. Now, some people love being at their charts in trading, especially those discretionary traders.
Which is part of the reason why we're doing this, because we're trying to take that part out.
Right?
Yeah. The automation is not only the benefit, but it's also the key advantage.
Yeah, it really is a key part.
It is the beauty about this. It's really important that it be automated.
And we're going to have a lot of videos about that automation and how it works. We're going to show you. So be sure to subscribe and to the channel. We're going to bring that content. But really, the TradingView we can generate the code, the alert. Then Traderspost is the third party that then sends the signal to our broker. And in this case, it's TradeStation. So it goes from TradingView to Traderspost to TradeStation. And it works really, really good.
Is it just coincidental that they all have trade in the name?
Yeah, I know it can be really confusing.
It looks like they're all affiliated, but
yeah. And then futures, we've really learned that futures works great with the automation trading, because it's the way that futures settles. There's no settlement waiting period. You can You can buy the NASDAQ and the S&P 500 in a micro. And again, we're going to, in our videos, we're going to continue to talk about this, but the futures is great and it's super easy and not something scary that people should be really afraid about. But they work in standard personal, non-retirement accounts, IRA, SEP IRAs, business trusts. You can do futures. Yeah, you can do a futures Roth. I mean, all that traditional rollover, all of it.
I'm actually rolling over a Roth or a 401k.
Yeah,
like in the next few weeks.
Yeah, so
this is all very applicable.
Yeah, so when you have that 401k rolling over, it's a great thing to do. No, that's for us. I mean, that's what we are doing, and that's what we're sharing with you, is showing you what we're doing. Now, in the end, we met our goals. We had the 20% returns, and we're going to show you this right here on the screen. Is what the results look like using futures. Now you'll see a suggested account size, and again, you up on the top, you'll see 2 micro NASDAQ futures, and it goes all the way to the right where you see 12 micro futures. The point is that this is an example of what these look like, where you blend strategies. Because these are different strategies. The more money you have, the more strategies you can put in there. But you can really achieve the 20% goal of return with limited drawdown. I mean, really, with the more strategies you have, like you can, with 6 strategies employed, activated, we can do about 23% return.
So what is the real advantage to doing the 12 micro over the 2 micro?
Is that the portfolio, the multiple strategies, the more strategies are firing at different times, you're reducing the risk, you're reducing the drawdown. And
right, so that's the big thing. You look, I mean, the IRR and the ROI are relatively similar,
close,
but it's just that max drawdown. So that's gonna be the biggest benefit when you look at these different options here. As to how much tolerance can you take. Again, if you've got a smaller amount of money that you want to work with, again, 28% max drawdown, that's not bad. But if you want to reduce that and you happen to have, 200 plus, then look at that, 17. That is a big difference.
So I have accounts that are all sorts of different sizes, and I can kind of pair them up with the right with the number of strategies. And on the screen right now, there should be a video of our next video that would help you, show you how you can trade along with us. We're going to show you the strategy or how you can trade along with us. And in the description will also be more information as well. But we really look forward to helping you through this journey, because we're doing it with our own money, and we're happy to share this with you.